89 days ago, Michael Burry, the man who made $2.7 billion betting against the housing market in 2008, made a move so bold, so concentrated, that it sent shockwaves through the institutional investing community. On October 27, 2025, Burry announced he's liquidating Cyan Asset Management, returning all capital to investors by year-end. But before shutting down, his Q3 2025 filing revealed the most concentrated contrarian position in modern investing history. $1.1 billion betting against AI stocks, 66% of his entire portfolio in a single put option against Palantir. And the financial media? They called him crazy. Again, just like they did in 2005 when he shorted subprime mortgages. Here's what the screens are showing you right now. Silver spot price, $90.88. The S&P 500 near all-time highs. AI stocks like Palantir and Nvidia still elevated despite recent volatility. Everything looks fine, right? But Michael Burry sees something different. And if you understand his playbook, his actual investment methodology, silver checks every single box. Let me be very clear about what I'm claiming here. Burry hasn't announced a silver position. There's no silver in his latest 13F filing. But when you analyze his 3-decade track record and apply his exact framework to current market conditions, silver emerges as the perfect Burry trade for 2026. Here's why. Burry's entire investment philosophy is built on finding assets that are 1. Misunderstood or ignored by the market. 2. Trading below intrinsic value with a margin of safety. 3. Positioned opposite to consensus/bubble behavior. 4. Backed by structural fundamentals the market hasn't priced in. Let me show you how silver fits every single one of those criteria. Let me walk you through Michael Burry's actual investment methodology. Not the Hollywood version, but his real process refined over 25 years. According to his documented strategy, Burry combines 3 core principles. Principle number 1, deep value investing with forensic analysis. Burry doesn't make quick calls. He spends hundreds of hours reading 10Ks, analyzing cash flows, evaluating management, and calculating conservative intrinsic values. He only invests when price is 30 to 40% below calculated fair value, what he calls a margin of safety. Principle number 2, extreme contrarian positioning. When the market shows excessive pessimism toward a sector, that's when Burry gets interested. His biggest wins came from zigging when everyone else zagged. 2000 to 2008, shorted housing when everyone said real estate only goes up. 2019, bought water rights when everyone ignored infrastructure. 2023 to 2024, accumulated Chinese tech when everyone fled to US stocks. Q3 2025, shorted AI when everyone crowned it the 4th industrial revolution. Principle number 3, concentration over diversification. Burry's Q3 2025 portfolio had just 8 positions. His Palantir short represented 66% of the entire portfolio. That's not reckless. That's what conviction looks like when you've done the work. Now let me show you how silver matches this exact framework. Silver's deep value case. Let's run Burry's forensic analysis on silver's fundamentals. Supply-demand imbalance, global production, 850 million ounces, 2025. Global demand, 1.05 billion ounces, 2025. Annual deficit, 200 million ounces for 5 consecutive years. Above ground inventory depletion. COMEX registered 38 million ounces, down from 120 million in 2020. A 68% drawdown in available delivery stocks, price versus production cost. Current price, $90.88 per ounce. Average all-in sustaining cost, $32 per ounce. Margin, $58.88 profit per ounce, 65% margin. But here's the kicker, that $90.88 price doesn't reflect the industrial supply crisis brewing. China's export controls took effect January 1st. Only 44 companies globally can export from the world's largest refining nation, 70% of global capacity. If Burry ran his intrinsic value calculation on silver, factoring in structural supply deficits, accelerating industrial demand, solar, EVs, AI data centers, and geopolitical supply shocks, he'd likely calculate fair value between $130 to $180 per ounce. Current price, $90.88, conservative fair value. $130. Upside, 43% margin of safety. Check silver's contrarian setup. Now let's look at market sentiment, Burry's second criterion. Wall Street consensus right now is AI stocks are the future, Burry's shorting them. Bonds are safe, Burry wrote they're unappealing. Precious metals are boomer assets. Burry bought Sprott Physical Gold Trust in Q1 2024. And silver specifically, financial advisors tell clients, it's too volatile for retirement accounts. It doesn't generate cash flow. Industrial demand will collapse in a recession. That's textbook excessive pessimism, exactly what Burry looks for. But here's the reality hiding beneath that pessimism. Industrial silver demand grew 15% in 2025, despite recession fears. Solar installations, up 20% year-over-year. EV production, up 18%. 5G infrastructure, up 25%. AI data centers, up 30%. Every single one of those sectors requires silver. Not wants it, requires it. There are no economically viable substitutes at current technology levels. So while Wall Street says precious metals are dead, industrial users are panic hoarding because they can't source enough supply. That disconnect between financial market sentiment and physical market reality is classic Burry territory. Contrarian positioning, check silver's concentration potential. Burry's Q3 2025 portfolio shows he's willing to put 66% in a single position when conviction is high enough. Could he do the same with silver? Absolutely. Here's why. 1. Liquid market, $90 silver at 850 million ounces. Annual production equals $76.5 billion market. Large enough to deploy serious capital. 2. Multiple entry points. Physical metal, mining stocks, operating leverage. Sprott Physical Silver Trust. He already used Sprott for gold in Q1 2024. 3. Asymmetric risk-reward. Downside limited by production costs, $32 per ounce floor. Upside unlimited if industrial supply crisis materializes. 4. Time horizon matches. Silver squeeze could take 12 to 24 months to fully develop. Perfect for Burry's typical 1 to 3 year holding period. If Burry ran his numbers on silver today, he'd see 43% upside to conservative fair value structural supply deficit. Worsening market ignoring or dismissing the thesis. Clear catalyst. China export restrictions already in motion. That's a textbook Burry setup. Now let me show you the parallel between his current AI short and a potential silver long. Here's where it gets truly interesting. Michael Burry's $1.1 billion bet against AI stocks is actually a roadmap for understanding why silver is the perfect contrarian play right now. Let's break down Burry's AI thesis from his Q3 2025 positioning. The AI bubble, Burry short. Palantir PUT, $912 million, 66% of portfolio. NVIDIA PUT, $186 million, 13.5% of portfolio. Total AI exposure, 79.5% bearish. His argument based on analyst interpretations. AI valuations, completely disconnected from reality. AI infrastructure has short economic life, 2-year depreciation versus 5-year accounting. Massive capital spending won't generate promised returns. When companies realize ROI isn't there, spending collapses. Both AI users and suppliers, NVIDIA, get crushed simultaneously. Now here's the parallel most people miss. If Burry is right about the AI bubble popping, capital has to flow somewhere. And historically, when tech bubbles burst, capital rotates into hard assets, gold, silver, commodities, value stocks, his Pfizer, Halliburton positions, inflation hedges, real assets that can't be printed. But here's the twist. AI infrastructure build-out will continue even if AI stocks crash. Microsoft stock might fall 50%, but they're still building data centers. Google's valuation might collapse, but they're still deploying AI at scale. The infrastructure demand is real, the stock valuations are fake. And guess what AI infrastructure requires? Silver. Let me show you the math. Each AI data center, 500 to 1,000 kilograms of silver in electrical infrastructure. Each 5G base station, silver conductors for high-frequency signals. Each EV, 25 to 50 grams of silver contacts, each solar panel. 20 to 25 grams of silver paste. So when the AI bubble pops, Burry's bet, two things happen simultaneously. 1. Capital rotates from AI stocks into hard assets, including silver. 2. AI infrastructure build-out continues, maintaining industrial silver demand. This creates a perfect setup. Declining stock valuations plus persistent industrial demand equals silver outperforms massively. Now let me show you how Burry's complementary positions validate this thesis. In addition to his AI shorts, Burry holds Pfizer, 11.07% via calls, defensive value play Halliburton, 4.45% via calls, energy/commodity exposure, Molina Healthcare, defensive essential services. Notice the pattern? He's short the bubble, AI, while long defensive value and commodities exposure. That's not random. That's portfolio construction for a regime change, from speculative growth to hard assets and value. If he were building that portfolio today with perfect information, silver would fit perfectly as hard asset, like his gold exposure via Sprott in Q1 2024, commodity with industrial necessity, like his Halliburton energy play, contrarian positioning, market ignores it while chasing AI stocks. The margin of safety calculation. Let me run Burry's actual framework on silver using his documented methodology. Conservative intrinsic value calculation. Starting inputs. Structural deficit, 200 million ounces per year. Supply cannot increase, 10-year mine development lag. Demand growing 15% annually, solar, EV, AI, 5G. China export restrictions eliminate 70% of global refining capacity from free market price required to balance market. At $90, deficit persists, demand greater than supply. At $130, some demand destruction begins, substitution, efficiency gains. At $180, significant demand destruction plus incentive for new supply, but won't arrive until 2033 plus. Burry's 30 to 40% margin of safety. If fair value equals $130, buy below $91. If fair value equals $180, buy below $126. Current price $90.88. Margin of safety 30 to 40%. That's why silver fits Burry's framework perfectly. You're getting a structural supply deficit that's mathematically unsustainable, at a price that's 30% plus below where equilibrium should be. Now let me show you why timing matters and why 2026 is the perfect window for a Burry-style silver play. Burry's documented strategy includes precise catalyst timing. He doesn't buy undervalued assets and wait indefinitely. He identifies specific catalysts that will force the market to reprice within 1 to 3 years. Examples: housing short, 2005 to 2008. Catalyst was ARM resets and defaults water rights, 2019. Catalyst was infrastructure spending and climate stress Chinese tech, 2023 to 2024. Catalyst was reopening and valuation reset AI short, Q3 2025. Catalyst is ROI disappointment and spending cuts. For silver in 2026, there are 5 major catalysts converging. Catalyst 1, China export controls, already active. Took effect January 1st, 2026. Only 44 companies can export silver from China, 70% of global refining. This is not reversible. It's strategic policy tied to national security objectives. Timeline: industrial panic hoarding begins Q1 2026, materializes in procurement data by Q2 2026. Catalyst 2, industrial supply crisis, 2 to 6 months. Solar manufacturers, EV producers, semiconductor fabs, they all order 6 to 12 months ahead. When they realize Chinese silver isn't flowing freely anymore, Procurement teams start competing for limited supply. Timeline. Procurement crisis visible in Q2 to Q3 2026 earnings calls. Catalyst 3, COMEX delivery crisis, 3 to 9 months. Registered inventory at 38 million ounces. If just 5% of futures contracts demand physical delivery instead of cash settlement, that's potential for complete depletion. Timeline. Not a 5-year hold hoping value gets recognized. A 1 to 2 year high conviction position with multiple overlapping catalysts that force a repricing. The personal battle plan, Burry framework applied. Let me share how I'm positioning using Burry's exact methodology. This is not financial advice. This is what I'm doing with my own capital based on Burry's documented framework. Position sizing, Burry style concentration. Burry put 66% in Palantir short. I'm not that concentrated, but I'm treating silver as a core position, 20 to 30% of portfolio, not a 5% alternative asset allocation. Why? Because if the thesis is right, if industrial supply crisis plus China restrictions plus AI bubble pop all converge, silver doesn't go up 20%. It goes up 100 to 150%. Entry strategy, margin of safety. Burry buys 30 to 40% below fair value. Silver at $90.88 with fair value of $130 to $180 gives me that margin. I'm entering here, not waiting for cheaper. Burry's housing short looked expensive in 2005 to 2006 too, but waiting would have meant missing it entirely. Instrument selection, Burry's actual holdings. 60% physical silver in allocated storage, mimicking his Sprott physical gold position from Q1 2024. 30% silver mining stocks, operating leverage play similar to his Halliburton energy exposure. 10% dry powder for adding if price dips below $85. Exit triggers, Burry's catalyst-based exits. Burry exits when catalysts play out or thesis breaks. My triggers. Exit trigger 1. Silver hits $130 and industrial supply normalizes. China eases restrictions. New supply comes online. Take 40% profit, let 60% run. Exit trigger 2. Silver hits $180 and demand destruction becomes visible. Substitution accelerates. Industrial users reduce consumption. Exit 80%. Keep 20% for potential overshoot. Exit trigger 3. Thesis breaks. China floods market with silver or industrial demand collapses. Exit immediately, reassess. The window is closing, not in months, in weeks. Look at his Q1 2024 position in Sprott Physical Gold Trust Study, the China Export Controls, January 1st, 2026. Run the supply-demand math. 200 million ounces deficit, 38 million ounces inventory. Don't take my word for it. Do the forensic analysis Burry would do. Spend the hundreds of hours reading data. Calculate intrinsic value. Identify catalysts. Build conviction. If you see what I'm seeing, if the data confirms the thesis, then you have a decision to make. The smart money is already positioning. Hedge funds accumulated silver in Q4 2025. Central banks bought record amounts of gold and quietly silver. Industrial buyers are securing supply before panic sets in. By the time Burry's AI short pays off and capital rotation accelerates, by the time CNBC runs segments on the silver supply crisis, by the time your financial advisor suggests maybe 5% in precious metals, the opportunity will be gone. You'll be buying at $150 while contrarians bought at $91. You'll be watching the largest commodity squeeze in modern history from the sidelines. Michael Burry has given you the framework. He's shown you how to think like a contrarian. He's demonstrated that the biggest opportunities come when the market is maximally pessimistic about assets with strong fundamentals. Silver is maximally pessimistic right now, and its fundamentals are the strongest they've been in decades. The question is whether you're going to apply Burry's playbook or whether you're going to follow the consensus that's been wrong at every major inflection point for the last 25 years. Thanks for watching. Leave a comment. Are you applying Burry's framework to silver? What's your intrinsic value calculation? This is the inflection point. This is where contrarian investors position before the crowd figures it out. The playbook is clear, The catalysts are converging. The question is whether you have the conviction to act. I'll see you in the next one. Stay sharp.